Hey, wealthy business family, welcome back. If you love understanding how world events impact your money, you are in the right place. Today we're going to talk about an incredibly dynamic set of stories that are moving markets across Europe, the US, and honestly the entire globe. Let's take a breath and break this down carefully. The euro weakens, a signal of market unease. First off, let's talk currencies. This morning the euro is down about 0.3% against the US dollar, and the British pound is down roughly 0.4%. That might sound like a small change, but in the currency world these are meaningful moves, especially when they come on the back of major data releases and political turbulence. So what's causing this? Well, on Tuesday we saw stronger than expected numbers coming out of the US. Job openings were higher, and manufacturing activity came in above forecasts. That is telling traders that the US economy is still rolling forward, even with higher interest rates. If the US stays strong, then the dollar stays strong. And when the dollar strengthens, the euro and the pound typically slip. What's up with the Fed? Powell plays it cool. Now let's pivot to the Federal Reserve. Jerome Powell, the most powerful central banker on earth, spoke earlier this week, and he was, let's say, careful. He refused to rule out a July interest rate cut, but he also didn't promise one. That left the market in suspense. ING strategists summed it up really well in their Wednesday note. Powell's remarks keep the dollar extremely sensitive to any jobs or inflation surprises. That means if the payrolls numbers come in weak, markets might suddenly assume a rate cut is just around the corner. But if the numbers come in hot, then the Fed will keep rates higher for longer, and that will support the dollar even more. So watch that data like a hawk, because the next Fed move could hinge on a single jobs report. Britain's gilt yields and a fiscal tightrope. Okay, now let's fly back over the Atlantic. In the UK, borrowing costs have been on a roller coaster. Gilt yields, these are the UK's government bonds, popped higher this morning after drifting lower yesterday. Why? Because of political drama. Bank of England Governor Andrew Bailey made some soothing noises about being flexible on the pace of quantitative tightening, meaning he might slow down how fast the Bank of England pulls cash out of the system. That calmed nerves temporarily. But then, fiscal worries came roaring back. Prime Minister Keir Starmer barely got a controversial welfare reform bill through Parliament last night. To get it passed, he had to strip out key cost-cutting measures, including a tougher benefits eligibility framework. 49 of his own Labour MPs voted against him. That's a rebellion right inside his house. Originally, those reforms were supposed to save the government £5 billion a year by 2029 to 30. Now, they might cost £200 million a year instead. Think about that. A swing of more than £5 billion. That means Finance Minister Rachel Reeves will have to find money somewhere. And guess what? That means higher taxes could be coming this autumn. Helen Miller from the respected IFS think tank spelled it out. With spending plans basically locked in and no more savings from welfare, taxes will almost certainly have to rise to hit budget rules. And you know what happens when taxes go up? Investors and everyday families get nervous. Spectrus and the big buyout buzz. Let's lighten it up for a minute with a positive corporate story. Spectrus, a name you might not follow every day, is a high-tech equipment maker out of London. Their shares surged over 5% today because private equity titan KKR made a huge new takeover bid, £4.1 billion or £40 per share in cash. That's a premium of almost 96% compared to where Spectrus shares traded just a month ago. That is big money. Earlier, Spectrus had been in talks with KKR rival Advent, but Advent's offer was a bit lower. Some analysts argued it didn't capture Spectrus's full medium-term potential. KKR clearly agreed, and they opened the wallet wider. It's a reminder that even in times of macro stress, there is money hunting for opportunities, especially when solid companies look cheap. Europe's bigger picture, ECB and Sintra-Watch. Let's zoom out again to the continent. The Stoxx 600 index is up around 0.35% this morning, powered by banks and miners. Investors are watching carefully what comes out of Portugal, where the European Central Bank's annual forum on central banking is taking place in Sintra. Christine Lagarde, the ECB president, is scheduled to speak today, along with other heavyweights like Portugal's central bank governor Mario Centeno and Bank of England boss Andrew Bailey. The rumor mill is that the ECB could lower rates in September because Eurozone inflation has finally cooled to 2%, exactly their target. So markets are basically on Lagarde watch today for any hint of how aggressive or cautious the ECB will be going forward. The Trump factor, tariffs and uncertainty. And of course, how can we talk markets without talking about Donald Trump? His so-called one big beautiful bill is still making its way through Congress. If it goes through, it could bring a fresh round of tariffs and trade fights. That's why Jerome Powell mentioned that without Trump's trade tensions, the Fed probably would have cut rates already. So even trade policy, politics, is shaping what the central bank can do. That's huge. Trump's moves matter because they raise the cost of imports, they change supply chains, and they ripple through everything from inflation to corporate earnings. So keep your eyes on that bill. It could tip the scales for the whole second half of the year. Takeaways for investors and everyday people. Let's step back. Here's what I see in the bigger picture. Europe is stressed, the euro is weak, and the UK is facing higher taxes. The US is resilient, but the Fed is cautious, and data-dependent central banks in Europe are leaning toward cutting, while Trump's trade plans keep them nervous. Corporate deals are still happening, proving there is opportunity out there. And underlying all of this, people are worried about growth. Can Europe grow if it's stuck in budget fights? If you're an investor, here's my simple advice. Stay diversified, stay flexible, keep cash on hand for bargains, and don't be afraid of volatility. It's often where the best opportunities come from. Your turn. Let's discuss. So, what do you think? Are you worried about more tax hikes in the UK? Do you believe Trump's tariffs will change the Fed's mind on rate cuts? How do you see Europe navigating these budget struggles? Drop your thoughts in the comments. I always read them, and they help us all learn together. If you found this breakdown helpful, please hit that like button, subscribe to Wealthy Business, and ring the notification bell so you never miss an update. Remember, knowledge is your greatest investment. Stay smart, stay wealthy, and I'll see you in the next episode.